Welcome back to the E&S Hoover Show. I had the great opportunity of sitting down with Clayton Hepler about a new vehicle that is out there for you to use to avoid paying taxes and to use this insurance. It's a type of insurance to help you invest in multiple different investment vehicles out there, all while getting a compound return. It's a very unique product. I'm skeptical, as many people are. And by the way, we are not financial advisors. We are not accountants, so you should definitely get with your financial advisor or accountant before uh, using his service or any service for that matter when it comes to the financial sector. However, it's important to know that these things are out there. And I definitely plan on doing my due diligence, digging into this more, and probably using this in my investing in the future. We also talk about some other things, how he got started. He had a really interesting path to becoming an entrepreneur, and also towards the end we talk about some books, and we get into a little bit of fun with space conversation as well. So it's a fun conversation. It's a long conversation, but there's a lot of really good information here. I hope you enjoy this, and hit me up on social media at ENS Hoover if you ever want to come onto the show or just communicate in general for any reason. And then also, please like and subscribe to the podcast and to the YouTube channel. Your support definitely helps me continue to grow and produce content for you guys. Enjoy the show. Welcome back to the E&S Hoover Show. I got Clayton Hepler here with me. How's it going, Clay?
Never been better, actually. We were just looking at a deal before this. And I think you just talked me off the ledge.
Hey, now I always love breaking down deals, but I'm a very, very conservative person when I break down deals because as we were talking about, I've seen the dark side of the real estate world. Right, we're in right now, like where everything's in rose-colored glasses, and like even the most the real estate investor who has no experience and no knowledge can probably do a deal right now, and it'll make sense because
Right.
like rents are so high and whatever the deal is. But at some point that'll flip flop, and it'll be a little darker times, and it'll be a little harder for people. But usually when that happens, sales prices go down a little bit, so then the educated investors can scoop up.
Yeah, and I think that's one of the things we're going to talk about today is where are you flowing your money, right? Where are you putting your reserves, your vacancies, your repairs and maintenance, your taxes, and how do you do that more efficiently? Because a lot of people, they just put their money in a bank account and think that that's the best way to do it, and I don't believe that's the best way to do it.
Well, we're going to talk about that, and I was just on your show last week, and I don't know when that goes live. You'll have to let me know so I can share it around or whatever. And then we're doing the flip flop here on my show this week, and we're gonna get into this. I actually just found out some interesting stuff when we had lunch the other day that you have a very interesting background, and I don't know why we never got into that before, but you kind of got dropped out of school, right? As a lot of us entrepreneurs or investors or whatever you want to call us. I don't like the word entrepreneur that much, but as whatever word you want to call us, you dropped out of school just like most of us do, and then you decided to join the family business. Why don't you talk about that a little bit? Tell me why you dropped out of school, and then let's talk about your family business because it's quite amazing.
For sure, yeah. So basically, Ian, we were talking about this the other day. I was like driven to work as an ambassador. Like I wanted to be an ambassador. Like I was a senior in high school and I got a semi Fulbright scholarship to study in Spain, like U.S. Spanish relations. And then I worked for the embassy, U.S. embassy, the State Department in Buenos Aires in Argentina. And so what I studied in college was like political theory and, U.S. Latin American bilateral trade and economic relations, which is like a bunch of like theory and understanding historical data points, and then just like sitting in a room and talking about policy and like really not getting anything done. Right. Like, so I I experienced that on the first hand when I was stamping passports. And when I was in Argentina, I was doing sort of like stamping passports and helping like expat entrepreneurs with building like micro businesses in Buenos Aires. Because those who are not very privy to geopolitical stuff, basically everything in Argentina is done in dollars because the peso is so inflated. It's like 30%, 50% every year. It gets inflated more. So like real estate's in dollars, people are paid in dollars, like teachers are paid in dollars. And so that was a really interesting sort of micro or macroeconomic experience that I had early on. But long story short, I hated the job, right? And so I didn't really know what I wanted to do because I was a college athlete as well and ended up having a career-ending injury. So I was like, I'm going to take some time off of school, right? And at that point, my mother had a chocolate business, luxury chocolate. So what we did was we imported Swiss and Belgium chocolate, and we would make it into toffee in a variety of confectionaries. And I figured out that I had a knack for sales. And so I grew the business from 2 to 42 states in like 18 months, got partnerships with people who are local to Pittsburgh, the Omni William Penn, the Omni Hotel chain in the East Coast. We had partnerships with QVC. And so during that time period, when I was just out there by myself, I met a guy that was an incredibly successful entrepreneur. And the guy had real estate. That's why I originally got into real estate. The guy was I had a couple of like specialty shops, like grocery stores, and he was pretty diversified across a variety of different industries. But I learned from him a lot of different like strategies and tactics that were like just not taught in school. We're taught like put your money in a 401k and IRA, hope one day that I'm going to be wealthy, delay, defer, save, scrimp, cut back, be the millionaire next door. And this guy said, no, that's not how you get wealthy. And so I had this huge paradigm shift, and it took me a while to have a paradigm shift. I have a plethora of stories about having a scarcity mindset, but I grew the family business, and then I got out of the family business. I said, hey, I want to try my luck at something. So I joined an awesome firm here in Pittsburgh and, did some acquisitions work. And last year did a lot of acquisitions work and wholesaling and flipping. And all along the way, I'd been still studying these strategies. Unfortunately, my mentor has since passed, but had been studying these strategies that he taught me and implementing my own life. And now what I'm doing is I'm still investing in real estate, still have my W-2, but I'm helping entrepreneurs, high producers, real estate investors, with what I learned from my mentor, creating, protecting, and multiplying their cash flow.
I like it. So, you were in the chocolatier business. Is that what it's called? I think I might.
About it.
You got muted there for a second, but
confectionery, if you want to be like upper brow about it. Yeah.
Okay. Confectionery. All right. So, yeah, that's super entertaining and way cooler than anything that I did. I mean, I just worked for a crappy wireless company for, for like 8 years, and got people yelling at me and throwing their phones at me. And but you know what? Your path gets you to where you are today. And hey, that's really cool. And you speak a couple of different languages, right?
Yep, I speak Spanish and Portuguese. So
okay, so how do you say hello? How are you in Portuguese?
Hola, ¿cómo vai?
Okay, so it's very kind of similar to Spanish then.
Yeah,
right?
It's like drunk Spanish.
It's drunk Spanish. Okay, I like it. So that's really cool. And then the funny thing is, similar to what you got out of originally, is probably what I have kind of put a little pin in is like, if I someday decided to hang everything up, like I'll never retire, right? Like I'm just not the type of person that can just go and be like, oh, I'm going to go work on my golf game 30 hours a week or whatever to stay busy. And,
Right.
I run into these guys at the gym and I just don't know how they do it. But I actually took actually it was a broker's class when I was getting my broker's license with a guy who worked for the State Department, and his job was to negotiate like embassy deals, like leases and purchases for the embassies around the world. And he's like, yeah, the State's Department is always hiring, former real estate professionals. They usually want you to have like, at least 10 years, probably closer to 20 years experience. He's like, it's not like a super high paying job. Like, you'll make a decent living, but you get to travel the world and do a bunch of different things and stay in like awesome locations, and you get to meet powerful people. And I was just like, that just sounds
That's so
amazing.
cool. Yeah, yeah,
Yeah.
yeah.
Yeah. So that's probably like someday, whenever I'm done with my real estate brokerage or whatever, that's probably what I'm going to do, is as long as, as long as I'm just at that point where I'm cool with traveling, my kids are taken care of and all that. I mean, I'd love to just go travel the world and negotiate. Negotiating is the best part of real estate. Like, the worst part is dealing with contractors. The best part is negotiating. I love negotiating the deal. There's nothing that gets me so excited, right? Just let me negotiate.
What's it gonna take? What's it gonna take?
Yeah, how. I mean, you've seen firsthand my negotiating skills, right? So, there's been a couple of deals that you and I've been negotiating on. So I love to negotiate. And you know what? Like that one that I think you're probably talking about. That was that was so exciting to me, right? Like, just I saw enough, I knew it was a good deal.
Right. I know
I trust you as somebody who walked through. You're not gonna, if you saw that there was like a foundation wall collapsing, you're not gonna like sell it to me like sight unseen without telling me, like you're not that type of person. So like, I just kind of had confidence with the videos and the pictures. I was like, yeah, let's do this. Let's get it done. And then once it was done, and I had it, like, I waited till it was inked, because you just never know, And then the funny thing is, I was just telling that story to Brady Alford. Do you know him? Really? Okay. So Brady is his wife is one of my agents, Katie, and I guess they had seen the same property and like tried to call you and do the same thing I did, but they were just like too late or something. And he's like, I can't believe you got that. Like, I wanted that one. They've been trying to buy something in that community for a while, I guess. But yeah, no, negotiating the deal is the most fun part. Even like when I'm just representing people, I just love that part of the business.
For sure, man. Yeah, for sure.
I've read probably 30 books just on negotiating tactics and everything. Like, it's just so much fun, and I love it. But anyways, so you are now getting into something that's intriguing to a lot of entrepreneurs and people that are building wealth and stuff like that, right? And let's just be honest here. Nobody wants to pay Uncle Sam, right? Nobody wants to pay Uncle Sam 30% of what they make and everything. So we're always looking for new vehicles to do this with, right? And you brought something to me, and I gave you some criticism at first, right? Like, I gave you you have to simplify this pitch, right? It's got to be a 5-10 minute max type of thing, because it probably took 20-25 minutes for me to even just start to get like a little grip of what you were even pitching, right? What you were even talking about. Because at first it sounded like here's my whole bank account, just take it right now, right? Like, that's what, like, it sounded too good to be true. And I think it is a really good thing. Even Casey and I talked afterwards, and I think that I think that you got something good going on here. But you really have to understand what you're getting into, and really it's just like with real estate investing, it's the long game, right? And that's what we're all in it for. Look, if you're looking to get into any kind of investment and you want to become a millionaire tomorrow, I don't know what that answer is, because if there was out there,
it's a doggy coin.
It's a doggy coin. Yeah. Invest in Dogecoin when it's at like a tenth of a penny, and just hope and pray that thing turns into an 80-cent coin. And then yeah, you could become, it's still not overnight, it's still going to take years to get to that
point.
Right. So anyways, you got your insurance license, correct? Is that
that's correct.
Okay. And then you lined yourself up with the best company that does the specific niche you're trying to get into. Go ahead and tell us like what it is you're doing, what it's called, how it works. Let's get into it.
Sure. Yeah. So I like to start a conversation off like this and just ask kind of where do we all put our money, right? We put it in a bank account, right?
No, I
unless
don't.
you stash it right. You stash it under your mattress, right?
I
Or if
got
you're real, or if you're a real estate investor, you don't have any money. It's all in
right.
your properties, right?
Ding,
There
you're
you go.
getting it now, Clay. If you're a real estate
So,
investor, you have no money.
so here's what happens a lot of times. Real estate investors have a high degree of liquidity anxiety, right? Like we want to take our money and we want to use it like right away. But it's smart for us to put our money somewhere. So if there's any sort of capex, like we're taught as responsible real estate investors to have reserves for capex. That's capital expenditures for those who don't know, repairs and maintenance, for vacancy, and for other miscellaneous fees, right? But a lot of times, if you buy these properties right, you're going to go years without that money doing anything for you. It's just sitting in a checking account, you get your 0.01%. And we as real estate investors, we want to be the most efficient way as possible, right? Like we're always trying to get our money in, get our money out with a burst strategy, or we want our money to continue to move, right? So instead of putting your money in a bank account, and this is what I've learned from, I originally learned this from my mentor. Wealthy people put their money in specifically designed life insurance policies. Now, how is this different from a savings account? Well, it's just another place that you can think of. I'm going to put my money in, right? What's the difference? Well, it's tax-free growth at 4 to 6% per year. That's pretty attractive, right? People, a lot of real estate investors that I work with, what they do is they flow their money, instead of putting it into their bank account in particular, they put their money in this specifically designed whole life insurance policy. So Ian, at the time that you put your money in here, it's going to be growing at 4 to 6%. You can think about it like a high yield savings account with term insurance. So obviously there's life insurance there. So there's a death benefit. So if you were to pass away, your kids would get that money tax free, which is great. You and I had a conversation the other day that we think your wife is planning to take you out because of your life insurance policy. But
she'd be stupid not to.
Right, exactly.
I'm worth more dead than alive.
Right,
so
exactly.
Why not try and off me in some way, shape, or form? It's like a win-win for her. She doesn't have to deal with me anymore, and she gets a large sum of money. Like who wouldn't want to do that?
Boom. Yeah, right. So you're flowing your money through this system, right? This is the place that wealthy people have put their capital because it's tax-free growth. But here's where it gets really, really interesting. Again, we're thinking of this as our high yield savings account, and there's a term insurance or regular life insurance attached to it, right? You're putting your money in here, but where it gets really interesting is at the same time that your money is growing at 4 to 6%, because you have a specifically designed policy with a mutual insurance company, and we can get into all the nuances here in a little bit. We're just going to talk about the mechanics now. It's growing at that 4 to 6%. At the same time, you can put a line of credit, just like you would put a home equity line of credit on it, and you can borrow against your equity or your cash value, your savings in your policy. So when you borrow, it's like a home equity line of credit. You can go and use that for it's a loan from the insurance company, and you take the loan and then you go and pay for your big roof that you need to replace, or you pay as an opportunity fund to buy your next property, or as a portion of your down payment. You can use this as a portion of your down payment. Now, the best part about this is your money, when you take a loan out, very similar to real estate, it is growing at a guaranteed rate. So you're guaranteed to grow. Your money's guaranteed to grow, plus there's additional dividends. So you have a guaranteed contract with the life insurance company that you can take a loan out at any point. You don't have any credit checks. You just say, hey, I'm going to fill out a sheet and I need, $100,000 to go buy this piece of real estate. They're not going to ask you for it. It doesn't show up on your credit. And the money that you have in your life insurance policy is still growing at that time. So your
just
money,
taking a loan against your life insurance.
Exactly. Yeah. And it's just like life insurance and real estate, it makes, for a lot of my clients who are real estate investors, it just makes sense, right? As you put money into your life insurance policy, it's just like you pay your premium into your life insurance policy. It's just like paying for a mortgage. As you pay for your mortgage, your equity in your real estate property goes up. Well, your cash value in your life insurance policy goes up. You can collateralize it, the equity in your real estate property, with a line of credit. You can do the same thing with a policy loan in your cash value. It grows at a respectable rate, just like appreciation. I mean, as of late, appreciation has been pretty crazy. It's a tax favored vehicle, right?
Right.
And it's just like in with real estate, if you sell it, there's ways that you don't pay taxes. When you pass away, you don't pay any taxes on the death benefit in the life insurance.
So for those that don't know how insurance policies work, essentially you're getting a standard whole life policy, which whole life is different than term. Term is if you die within that term, they're paying out. Otherwise, there's nothing, right? There's no value to it, essentially. And that's why it's so cheap, right? Versus a whole life policy, you have that for the rest of your life. And the insurance company is gambling that you're going to live longer, so that they can make money off of the money you're giving them, right? Because they're just investing that money. But for your specific product that you're selling, it's actually a rider that goes onto it that gives you the access to do a loan against it. And what's that rider actually called?
Yeah. So what we do is a standard whole life insurance policy for those of your followers who are Dave Ramsey or Susie Ormanites, right? I'm sure a lot of real estate investors and entrepreneurs that are listening to this don't believe in the Dave Ramsey or Susie Orman type of philosophy, but the standard whole life that's sold by your Northwestern Mutual or your Mass Mutual agent that's the wrong policy, right? That's like the difference of buying a good piece of real estate that's efficient and cash flowing versus buying a appreciation real estate that is not going to give you any sort of cash flow in a really good area, right? So what we do here is we structure the policies in a very specific way, okay? So we have our base premium, which is what you would normally pay in for a normal whole life insurance policy, Ian. And then we have things called paid up addition riders. And so the paid up addition riders, what they do is they give us cash value early. Okay. So we design these policies because this is life insurance, guys. There's no free rides in life, right? And this is life insurance. So instead of in your first year, usually when you buy whole life insurance, you get 0% cash value in your first year, right? So you put all these premiums in and you get no cash value. You get very little cash value. We get 70% of the premiums that we pay in the first year show up, and they're able to be leveraged like we were talking about earlier. Okay. So within the first couple of years, usually 3 to 5, depending on your health and age, you break even. What that means is the amount of premiums that you pay in equal your cash value. And then for the rest of the life of your policy, you're earning that uninterrupted compound rate. You're still earning it during the time period that you're negative in terms of your cash value, but it looks, you can really understand it after you break even, if that makes sense. So in other words, to put this simply, we design these policies for maximum control, maximum liquidity, and maximum early cash value. So we design these as real estate investors and business owners because we are real estate investors and business owners. And it's a great place to store your cash that maybe you don't have to have it totally readily available, but you still need to have liquidity.
And when you do finally take some money out and use some of that money, you're essentially just like a 401k loan. You're going to pay yourself back with interest, I assume.
It's even better. So the every life insurance contract has what they called a guaranteed loan provision, which means you can take out your cash value guaranteed. There's no ifs, ands, or buts. They don't have to underwrite you for it. You can just take it out. And additionally, you can pay it back at the time frame that you want to pay it back. So you technically never have to pay it back, right? The only thing that happens is if you don't pay it back, they subtract it from your death benefit if you die, right? So say you have $1 million policy, death benefit and you have $100,000 loan outstanding, then your heirs get $900,000. Okay.
Gotcha.
So you define the payment period though. So if say, the interest rate now is 4%. Okay. And the interest rate that the policy loan is at 4%. But if you don't pay it for a couple of years, all that happens is it's an interest only loan that's declared on a yearly basis. Right. So you're taking this loan at 4%, and it's declared on a yearly basis, the interest. So it's interest only. You define the payment period. If you want to pay it back in less than a year, then you're only charged on the amount of days that you're outstanding. So you can actually, if you pay it down, you're paying down the principal during the year. So in the example of buying a piece of real estate, Ian, say you go out and use a policy loan as a down payment, and then you start getting cash flow in the first month. You use that cash flow. The cash flow from the property will pay down the principal balance and not interest. So you have a way to effectively reduce the total interest cost by paying it back sooner as well.
Gotcha. Okay. I mean, it's definitely a very cool and unique product. And when you say tax free, like you literally mean you're not going to pay any tax on what you take out of your policy.
Yep. Yeah. So it's just like a line of credit. You don't pay taxes on a line of credit.
You don't pay taxes on equity.
Right. You don't pay taxes on equity.
Okay.
And so you never pay taxes. Now here's the kicker. And because we're so specialized and we know all the nuances of this product, if you fail to pay the premium, so again, this is like a mortgage payment, you get foreclosed on if you don't pay your mortgage. If you fail to pay the premium, then the policy will quote unquote lapse. And there's different ways that we can structure it so it doesn't lapse. There's a way that we can use the dividends of the policy so it doesn't lapse. We can be creative about it. But on a very high level, if you don't pay for the policy premium and the policy lapse, that income or the policy loan is classified by the IRS as income because you took it out of your policy, right? And you didn't pay it back, so it's effectively treated as income.
So if your annual, like if you're like, hey, I'm going to put 50 grand a year into it, and then you have, let's just say you do 5 years, no problem, but then the 6th year you run into a little bit of a financial problem, and you don't have that 50 grand to pay. And in theory, you could take a loan against it to pay your premium.
Right.
Okay.
You could do that, but here's another thing you could do. Okay. So I'm going to emphasize this. We structure this for real estate investors. We eat what we use it. So here's why this is a good thing for real estate investors. You're not obligated to pay the 50 grand every year. You're only obligated to pay about 25% of that. You only have to pay the base premium to keep the policy in force.
Gotcha.
So what happens is, say you pay it for 5 years, you pay the 50 grand for 5 years. That's normally a lot of people like, they put 50 grand in. That's a normal number. And then in the 6th year, they say, I only can pay for the base premium because I had a super cash flow crunch year. I had 3 appraisals for my refinances that went into the next year and I couldn't pay it at that period of time. Can I catch up? Can I in year 7 pay that additional paid up additions in and get the cash value like I would have? Yeah, you can. You can catch up 1 year. So if you have a down year, it's like, listen, you only have to pay 25% of the total amount that you're committed to. And then in the next year, if you have a better year, like most people have ebbs and flows, real estate investors do, then you could just pay it back. And here's the thing. You don't even have to pay it back if you don't want to. We just recommend it to make this the most efficient vehicle for your capital. Okay. So if you later on, you're like, Clay, I don't really want to have to pay this certain amount every year. You don't have to. It just won't make your policy as efficient, as effective as possible. So you're not committed to pay $50,000 for the rest of your life.
So in that theory, so let's just say 25% is what you were talking was like the regular premium, I'm assuming that's like a rule of thumb. So that's $12,500 a year. Why wouldn't I just sign up with the base premium of $12,500 per year, and then just throw extra money on it whenever I have it. Wouldn't that make more sense?
Ooh, I like the way you think, Ian. So here's why it would be better to do the $50,000, because what you're doing with putting the $50,000 in versus the $12,000 is you're giving your policy more liquidity and cash
Right.
during the period of your policy, right? So you're basically paying for the $12,000, $12,500, whatever you said it was every year, but you have all that additional cash that's going to get dividends declared. So over the period of your policy, the amount of compounding of your dividends is going to be way greater. If you
Right.
have that
It's just like the old, like if you pay an extra mortgage payment a year, you pay your mortgage off so much quicker or whatever.
Right.
It is, right.
Right.
So
Right.
it's just that same theory. But in theory, somebody could do that. Say, hey, I'm just getting the base policy, and then whatever extra I have every year, I'll throw on.
Yeah. I mean, you literally could do that.
Okay.
You literally could just,
It'd be stupid, but you could do it.
yeah, you can literally say, you could be like, hey, Clay, I want a $50,000 policy. I'm just going to pay you $12,000 a year. I'd be like, why are we structuring it for 50,000 though? And you say, well, I want flexibility. And I said, okay, maybe some years you pay 30 in, maybe some years you pay 70 in, and then
Right.
30 and then 70, and you're right. And so you catch up and
Yeah. You know how it is. I mean, some years you hit some home runs and you got tons of extra money, and some years you hit some singles and you're breaking even, you know.
And so that's why we structure these in the way we do, right? Because real estate investing in general, this is a product specifically designed. The way that we do it is for real estate investors, entrepreneurs as well, but primarily real estate investors. And we know that real estate investing is a cash poor business. You and I both know this, right? And so some years you're hitting the cover off the ball and some years you're not. All I'm saying is you're not storing your money in the most efficient and effective way. And this is a way for you to get creditor protection, tax-free compounded 4 to 6% growth, the ability to have your money earn uninterrupted interest for the amount of your entire life. So when you have your vacancy reserves, your CapEx reserves, your additional reserves, you can put it in here, and that money is going to compound. Once you put it in once, it's going to compound for the rest of your life. So like you said in the example of the $50,000, right? We could set up a policy. It's $50,000 for you. And you said, hey, 1 year, you know what, Clay, I didn't really have that many vacancies this year. I can put the entire premium in it. It's not going to be the most efficient policy if you don't do it. But if you have a year that's like you don't have that many issues with CapEx and vacancy, great. We'll structure a policy so that money's going to compound for the rest of your life. But if it's a down year, great. You don't have to pay everything in it. I would recommend you would. I'd recommend you figure out a way to do it. But that's why we structure these in the way we structure them.
Okay.
If you need to buy a Jaguar, if you
I lease.
Right. No. I like to give you a hard time, but
I might buy it at the end of the lease with this one because I really like this one, But I'm okay. So I'll tell you a little story. Okay, so I had a Jeep. It was a 2007 Jeep Patriot, and this was like when I bought this when the automobile industry was going through some really rough times, right? And they were getting bailed out by the government, and Chrysler was offering this unlimited powertrain warranty, right? Unlimited miles, unlimited years powertrain warranty. So at any point in your ownership of that vehicle, if the engine, transmission, or drive shaft went bad, then it was replaced by Chrysler. Sounds pretty amazing, right? So me going like, wow, this is awesome. I'm going to buy a Jeep, right?
Right.
I bought a brand new Jeep. It was the second new vehicle I ever bought in my life. And I'm like, I'm going to run this thing till the wheels fall. This is going to be like my kid's car someday. I'm like 21 years old, but this is going to be my kid's car someday. This is going to be like my grandkid's car someday because Chrysler's on the hook for the most expensive parts in this vehicle, right? Long story short, fast forward to 6 years later, I had this vehicle for 6 years. I'm driving to show basically show a $350,000 house in Squirrel Hill. Okay. And, I'm just getting my real estate business going. I'm just starting to make some good money, and my Jeep breaks down. And this was a brand new client that I hadn't met yet. So I was meeting them at the property. The Jeep breaks down, and I had to cancel the appointment. This was before like Uber was really big, or I couldn't just call an Uber and like go to the property, right? I had to wait for the AAA tow truck, whatever, to get there. And those people never rescheduled with me, right? So I lost a $350,000 buyer. Now, $350,000. I just want to run this through with you here. One side of the of 350,000, about 3%, right? That's $10,500 in commission, right? Now, the agent doesn't get all of that in theory, right? But either way, it's a large commission check that I missed out on because my Jeep broke down. And I was like, man, that really sucks, but that's okay. I have this unlimited powertrain warranty. My vehicle get fixed. Long story short, my engine was on its last leg and it was dying. And Chrysler was like, you need your engine rebuilt or a new engine. And I was like, oh, well, that's good. Go ahead and take care of it with that unlimited warranty. And they're like, what unlimited warranty? I was like, the one that came with the vehicle when I bought it, right? Well, here there was a little tiny stipulation in there that says that you have to go in at the 5-year mark for an inspection, right? They have to inspect your vehicle, make sure you're maintaining it, right? And I was like, well, I had no idea of this, right? It was literally a little tiny fine print on the contract. Nobody told me this. And I was like, well, and they're like, oh, well, we send you a postcard in the mail. And I was like, really? Okay. Well, what postcard do you send that address to? Cause I'm a real estate investor and I've moved 4 times in the last, 6 years. Right. And they're like, dude, right. We don't know. We don't know what address. Right. And I was like, and what does this look like? Is it like a letter? They're no, it's just a little postcard saying you need to come in for your checkup. I was like, I can guarantee my wife just threw away that post. She's like, what is this crap? I'll just junk mail, just throw it away. Long story short is, I didn't have an unlimited powertrain warranty anymore. So after that moment, I pretty much vowed to never, ever buy another Chrysler product ever again, right? Which I don't know if I'll stick to that or not. I mean, the Ram trucks are awesome, right? And who knows? Maybe someday I'll break down and buy one of those. But until then, I'm rocking an F-150. But the other thing that came out of it for me was like, that Jeep was probably worth like, with a good engine, was probably worth like $7-8 at that point.
Right, exactly.
I could have bought a whole nother vehicle. Yeah. I could have bought a whole nother vehicle with the commission I lost, right? So at that point in time, I started leasing from then on. I've done probably 10 leases since then. I get a brand new car every 3 years. I get to, use it and abuse it and give it back essentially. And everybody's always worried about, going over our miles and what if you damn it. I've never had an issue when I trade in a vehicle. And trust me, I have kids and I've leased my minivans and now we're into SUVs because they're getting a little older. And they cake, Cheetos into the seats and you can't get that shit out. They never charge me anything when I trade in these vehicles, right? So I leased, the long story short, and you still get a wonderful tax write-off. You get to write off all the payments that you make on that lease, right? So, it's not so it's not as good as buying, right? Because if you're buying, then you get to write off the total cost of the vehicle. But I mean, the total cost of my lease payments is still a pretty nice, hefty write-off, right? And the payments are a lot lower than if you buy. So there's a lot of benefits to leasing. And I know that not a lot of financial gurus are big fans of leasing, but I'm a big fan of it, mostly because I don't break down and lose $10,000 in commission.
Right. Yeah. And so, even that brings us back to using these policies. I can show you, and we can even do a webinar sometime in the future. And I do a wealth webinar Wednesday every week. I can show you why using one of these policies to buy your car is actually the best way to buy your car.
I can see how that could potentially work out, right? I mean,
because what you do, Ian, is when you put your money in a policy like this, that money for the rest of your life is going to compound. So instead of putting your money in cash, we have to understand that we're either paying interest to someone else or we're giving up interest that we could have earned, right? When we buy a vehicle, we're either paying interest to the bank or we're giving up the interest that our money could have earned on that cash. Yeah. And so if you flow your cash flow through this system, all of your cash flow, the most amount of your cash flow as possible, your money at 4, 5, 6% per year is going to compound, and that's compounding on the compounding of the capital. So in our lives, there are plenty of wealth transfers that we experience, right? The number one wealth transfer that we experience is by the I, R, and the S, our good friends down in Washington, D.C. that love us to tip them, right? The second biggest wealth transfer in our life is through debt and insurance, okay? That, you know, the average American spends 20 to 30% of their total budget on payments, credit card payments, car payments, payments to banks. And so what we do, if you want to take this even to the next level, is you use your pool of capital, your life insurance policy, as your own bank, hence the name cash flow banking. So if you can flow more of your cash through this, every dollar that you have, or not every dollar, like but I'm saying the more dollars that you have, that money, all of those dollars will continue to compound in your policy. And so when you take a loan out on your policy, the money that you would have put in your in just a bank account that wasn't earning interest is going to continue to earn interest during the period that you're paying back the loan. And also for the next 20, 30, or in the case of you, Ian, 60 or 70 years.
Oh, I'm not living that long. Come on.
What?
60 years, I'll be 94. Oof.
Oh man, I can see it. I can see
I'd be
by that time you're going to buy that mobile home park, I believe.
the oldest person in my family to ever live was my grandfather. My great grandfather was 88. So
okay,
I don't know. I'd be overachieving. We'll just put it that way.
I have a grandmother that's 98.
I'm gonna put you through the ringer right now. We're gonna make this interesting.
Let's do it.
You need to sell me. You're a salesperson, right? You told me you excel in sales. You need to sell me on why your system that you're selling, your insurance that you're selling, is better than the options I'm going to throw out there.
Let's do it.
Okay. First one. Tell me why your system is better than putting money in the S&P 500.
Okay. Great. So this is like a fallacy that the system, the life insurance system, is a savings vehicle. It's not an investing vehicle. So that's like the first thing. The S&P 500 is an investment vehicle. I wouldn't compare my money in my bank account to my money in my real estate or the S&P 500. So this is different, right? We're not going to compare the S&P 500 with.
No, let's compare. If I would,
okay, but that's
I'm going to put 50. Wait. No. I'm going to put $50,000 a year into the S&P 500 or $50,000 a year into your insurance. Which is the best route for me?
Okay, so it depends. Number one, it depends on your goals, right? Like we have to talk about. There's a difference here, Ian. This is investing versus saving, right? This is a savings vehicle, but if I must, I will talk about the difference here. Again,
okay.
It's totally different. This is something totally different. It's like trying to compare like a bicycle to a car. It's totally different. It's I guess it's not a mode of transportation, but it's just totally different. But let's talk about the S&P 500. Okay. So when you look at the S&P 500, they give you something called an average rate of return. Okay. Mm-hmm. So we look and we say, okay, the average rate of return of the S&P 500 is 7 or 8%, right? 7 or 8%, something like that after taxes or fees, right? Let me tell you why average rate of return is the biggest lie in personal finance, and why actual rate of return and something that economists call CAGR, compound annual growth rate, is a more accurate way of looking at returns. Mm-hmm. So let's jump into this, okay? I'm not that smart, so we're gonna start with $100,000.
Okay.
You put $100,000 in the S&P 500.
I got to correct your stats though. Since 1950, the average rate of return for the S&P 500 is 10.5% per year.
Okay. 10.5%. Is that's before inflation, correct?
I have no idea. This is Google. Okay. Yeah.
So let's talk about, we're talking average rate of return. I'm gonna show you why you're gonna look at me and you're gonna be like, man, I wish someone taught me this. All right,
You're teaching me right now.
$100,000.
Yep.
You get a 50% rate of return. Where does that go? That goes to $150,000. Okay.
Yep.
1 year, 50% rate of return. The next year, you lose 50% on your money. Where do we go? We're at $75,000.
Yeah.
Okay. What is the average rate of return over that period of time?
Well, you lost. Yeah. And then,
Right. Well, but what's
so
the average
that's a
rate of
two.
return?
That's
The average rate of return, you have to add both of the numbers together.
it'd be zero.
It'd be zero.
Yeah.
But that's not, but that doesn't actually reflect your actual rate of return. So if we take, so I can't go into like 6 or 7 or 8 or 9 numbers,
Right.
but if you want to like do the calculations, we can do the calculations here on the podcast, and I'll show you why average rate of return is a false metric. And if you look at really, really strong private equity firms, venture capitalists, they use what they call a compound annual growth rate, CAGR, or an actual rate of return. They look at the returns on a stock market portfolio or on a business differently than the average rate of return. It's a deceiving. So is that enough to show you why the S&P 500 is not a great investment and related to this? Or should I can go into volatility.
So there's a story that happened. It was, I think, in the late 2000s or early 2010s, where this guy made a bet with Warren Buffett. Okay.
I know about the bet.
Okay. Warren Buffett said, I will beat anybody, right? I'll just invest my money in the S&P 500. It'll beat any guru out there in their Wall Street betting. And then, of course, Warren Buffett won, and this guy had to pay, I think, $1 million or whatever the bet was, right? I think they did it to charity or something like that. But in theory, so like if I were to actually, because I have to look at everything as an investment. It doesn't matter if it's a savings or whatever. It's still an investment, right, Clay? So yeah, I'm just saying in theory, if you're getting an average rate of return since 1950, that's a long time, right? It's that we're talking an average rate of return of 10%. So if I put it in there for 20 years of my life, what am I going to get out of that versus having 20 years of my life in this savings insurance?
So again, this is, unfortunately, we aren't taught to look at this in the best way. And when I say that, I mean, I just proved that average rate of return is a metric that is not an efficient metric to look at your actual returns, right?
Yeah.
Number 2, if you put your money in on the worst days, so say you do the reason why people say you should dollar cost average is because you're effectively, quote unquote, you're not timing the market so that if you put your money in a bad day or a good day, over the period of your life, it's going to, quote unquote, equal out. That's not true. That's literally not true. Like if you look at, say you mistime the market and you buy at all-time highs. Like I bought Bitcoin at $68,000. It's $36,000 now.
It will go back up though.
I know it's sure.
Yeah.
It'll go back up. But if I buy in the period of my life, say I have 1,000 times that I invest, right? I dollar cost average, and I have 1,000 times that I invest, and you invest 1,000 times. You invest in a different day. So I invest on the 3rd of the month. You invest on the 8th of the month. My 3rd of the month investment, over that period of time, I invest in 20% more higher S&P 500 indices, right? So every time that I invest, it's 20% higher than you, and you get 20% lower. Let's just say that over 1,000 times, right? You're going to crush my returns because we're talking about volatility here.
Right.
We're talking about you were investing at different time periods.
Well, here, Mr. Salesperson, I'm just teaching you, right, Mr. Salesperson. You're moving the conversation in the wrong direction. What you need to do is say, hey, if you put $50,000 a year in the S&P 500, you're probably going to do pretty well for yourself, right? You're going to get a nice rate of return. However, when you go to sell that and take your money out at some point, you're going to pay Uncle Sam, right?
Yeah, right.
You're paying Uncle Sam. And then there's a bunch of other, I'm sure, little advantages.
Oh, I was going to get into that. I mean,
Yeah,
maybe I'm sometimes I talk a little too much, right? I talk a little bit too much. There's volatility. You can get it out. You can pay the capital gains. You're not paying any capital gains. Number two, if you get out, say you got out in 2008.
Right. Yeah. Oh, yeah. Absolutely.
That's called the sequence of return risk. You're screwed.
My 401k went from like 120,000 to like $10,000 in 2008. Like, and of course, me being a just uneducated, non-financial person at all, I was just like, oh my God, I got to sell this now so I can, and I paid like a 10% penalty, ripped it out. The only good thing that I did in that scenario, because I had nobody, like my whole family, there's nobody financial savvy in my family. I didn't get to learn from a chocolatier on how to, invest business or anything. So the only good thing I did was I took that, I think it was $8,000 after taxes. I took that $8,000 and I bought a property with it. And I made a decent return on investment off of that property, which then turned into other properties. So I probably, I always laugh at the people that like, I think we talked about on your podcast, like Donald Trump's not worth 10 billion. He's only worth 2 billion. Like, who cares, right? Like you made a return, right? You're worth a lot of money. Right. So in that scenario, I've turned that 8,000, I would assume probably into a hell of a lot more over the period of time. But if I would have just left it in there, the same thing would have happened. The money would have went back up.
Well, let me ask you this, Ian. Let me ask you this.
Yeah.
Do you think the taxes are going to go up in the future?
Taxes? Depends on who's in the government, who's running the house. In theory, taxes should go down if we're running things right, because when you reduce taxes, that's going to put more money into the economy because people have more liquid money to spend. And therefore they're going to, like we saw when they were giving out all that free money, what happened? People were pumping money into the stock market like crazy. And what did it do to the stock market? It made the stock market go crazy, right?
Right. But we're talking about the government here. Like, do you think the government is going to increase taxes because we have $29 trillion of debt, $305 billion of interest this year? I think it's inevitable. The taxes
they already have.
Right? They're going to continue to increase because we're at historic low income taxes. Taxes, capital gains are going to increase because people want to tax the rich.
1,000%.
So if your capital gains increase on your earnings, you're going to, your 9% turns into 5% or 6% really quickly.
See, now you're talking dirty to me, Clay.
So
see? You got to know who you're talking to.
You're risking over your lifetime. You're risking volatility. You're risking believing in the United States government that they're going to reduce taxes. I don't think there's anyone that could make a good argument against that. And you're giving up guaranteed growth, guaranteed dividends in a tax-free sheltered vehicle that can be leveraged throughout your entire life, hundreds of times, thousands of times, to buy more real estate, to buy more assets, while it's still going to grow at 5%, compounded, uninterrupted. And so you're never going to have to worry about volatility. You're never going to have to worry about the market crashing or Elon Musk, getting on Joe Rogan and smoking weed and the whole market crashing. All you have to do is wake up the next day. And if you die, your family gets tax-free, a tax-free death benefit. If you live, you can continue to leverage this policy throughout your life to expand your real estate empire, to expand your business empire, and to put your money in a place that's going to have a respectable rate of return. Okay. Let me ask you this, Ian. Sign right here.
Okay, so that was the S&P 500. Okay, I got another one for you.
Okay.
Why should I invest into your insurance, your savings plan, whatever you want to call it, versus putting my money in Tesla?
Again, we're talking about.
I know we're talking about investing.
We're talking about investing.
Yeah, I know.
It's equally like you don't view Tesla as an alternative. Like why would I put my money in a bank account versus putting it in Tesla? Well, you got to have your money in savings somewhere. Like, are you going to put all your vacancy in your CapEx budget in Tesla?
No, probably not.
Right. So let me tell you this though. These insurance companies that we use, Ian, has been declaring dividends since 1847. How long has Tesla been in existence?
2008.
Right.
Yeah.
2008.
Something like that. 2004, 2008, something like that.
So if you look at companies on the S&P 500, the churn rate is increased dramatically. And that means that the companies are getting disrupted by technology. Every company is getting disrupted by technology. Do I believe in Elon Musk? I believe in Elon Musk. But these life insurance companies have been in business for almost 200 years.
Do you really believe in Elon Musk?
I think he's a tremendous businessman.
I mean, I think he's a borderline genius for sure. And, but I also think that they would not shock me if tomorrow the dude's filing for bankruptcy, right?
Sure.
Like the guy has numerous times over leveraged, over promised, under delivered. And at some point that's going to bite you. Whatever you said, it didn't go through.
Oh yeah. I'm saying you're selling yourself on this. I mean, again, we're talking about an investing vehicle,
right? Yeah, no.
So
So how do you look at? Do you look at staking? Do you look at that as savings, or do you look at that as investing?
I look at staking as investing.
Really? Because that's a guaranteed rate of return right there. So okay, I'm intrigued that you think that way, because I kind of look at the overall. So if you're gonna put, for those of you who don't know, if you're listening, staking is the act of basically lending out your crypto to other people to make money off of it, right? They pay you a return back on your crypto, right? By staking it. And I look at the staking as a guaranteed savings, right? So I know I'm going to get 12.5% back on my Polkadot every, well, I think they pay out every week or whatever. But the investing side of it is, you don't know what's going to happen with Polkadot over the next, 3 months while you're staking it, right? It could go up, could go down, could go way up, could go way down. So you're kind of taking a risk on that side of things, but you do. So
what happens if it goes down? What happens if it drops?
Nothing, as long as you don't sell it, right? It just like any kind of, look, if you're going to sell low in anything you do, you're going to do bad, right? I can tell you that right now. That's the one thing that I've learned. Selling low does not equal out to success. You have some sort of weird mute thing going on with your mic. Every once in a while, you mute yourself, holds for a couple seconds. But it just, I'm just trying to get into your head, see how you think about things. Everybody looks at things differently, right? I do think.
The thing is, cryptocurrency I view as a speculative investment, because we're looking at the cryptocurrencies and saying, we think one of these is going to have valid use cases, but we're too early in the process to see what actually is a valid use case over the long period of time. So when I look at a cryptocurrency, when I look at an investment, I think about something called the Lindy effect. The Lindy effect is, I think Nassim Taleb was the first person that really brought it into the mainstream. And it's basically a principle that something that has been in existence, say for 10 years, has a very high percentage of being in existence for an additional 10 years, right? And so if we look at the Bible, or we look at old books have a disproportionately higher probability of staying in print and staying in circulation, or information has a disproportionate higher probability of staying in circulation if it has been in circulation for 200 years or 300 or 400 or 500 years. These principles are, when considered through the lens of the Lindy effect, a principle like a Bitcoin is like the first cryptocurrency. So a Bitcoin is a good investment using the psychological principle of the Lindy effect, because it is the longest lasting cryptocurrency. And so if you were betting and using that probabilistic principle, you would say that this is a good bet. And so when you talk dog coins and they're, 300 days.
We don't need to talk dog coins.
Yeah, right. Right. But this is how I look at investments, Ian. I look at investments with that in mind, using a series of mental models to evaluate, is this something that's going to last a long period of time? Okay. And that's why I love life insurance. And that's why I love real estate. I think a portion of all of our portfolio should be in cryptocurrency or Polkadot or Figure or Bitcoin or Ethereum or Solana or whatever you like, or it could be in fine art, or it could be in wine. But your core investment strategy, in my opinion, should be a barbell strategy. What that means is you have your safe investments. The majority of my net worth is in these life insurance. Well, not the majority, I guess it's in equity and real estate, but
right.
I have a decent amount of my net worth in these safe, easy, respectable 5-6% compounding life insurance policies that are guaranteed, that I know they're going to be there. And if I die, we're great. And then I have my real estate, which to me, because it's my core investor DNA, it's a part of who I am. I know real estate, maybe not as well as you do, but I feel like that's a little safer for me, because I don't believe that high risk is equal to high returns.
Sure.
I believe high knowledge is high returns. And so the other end of the barbell, right? So you got your core assets here, and the other end, which is a heavy lift, is the speculative investments. So, your cryptocurrencies, or sometimes maybe you're getting into a new venture, or, you're buying more businesses, or you're partnering, you're buying insurance insurance brokerage.
Sports gambling. Did we throw that in there? Speculative? No.
What was the
sports gambling? We'll throw that in.
Oh yeah, sports gambling. Yeah. I think that should be off the barbell. That's off the barbell. That's on the ground. That's
on the ground.
That's out of the gym. It's out of the gym. It's not even in the gym. No. So that's how I look at investing. I know that is kind of a long-winded way.
No, I like it. No, I'm more than anything. I'm just busting your balls, and I do think the product that you're offering, I think there's a lot of value there. I'm intrigued to learn more. So to just summarize a little bit for people listening in, you would contact you, which we'll talk about how to contact you here in a minute. You contact you, and you would sign up with this life insurance. And I think you even said a little bit yesterday that depending on your age and health and stuff like that, you may not even need to take an actual exam like you would with a traditional life insurance. That's a perk, because I just did that, and oh my God, like it was like an hour long of being poked and prodded and peeing in a cup and blood. And I think they even took a hair sample, if I remember correctly. I mean, they do all kinds of crazy stuff when you're trying to get life insurance. So that's pretty cool. And then from there, you invest. Let's just say you have a set amount that you invest. Let's say $50,000. Right away, you can get 70% of that in liquidity. So you could essentially in year one take a $35,000 loan against your life insurance already. Correct?
Yeah.
Okay. So like right off the bat, it's like I have $50,000 to save or invest, or however you want to. I have CapEx put aside, whatever you want to, however you want to phrase it or word it. I could put that in. It's compounding, because even when I take the 35 out, that 35 doesn't come out of my life insurance. I'm just taking a loan against that 35,000. So that 35,000 still stays in my life insurance, continues to compound at the 5 or 6%, 4 to 6% that you said, and it continues to build up over time. Becomes a very powerful thing when you're compounding, right? The compound effect, like the double a penny every day thing, right?
Yeah.
It just keeps going. I love the double a penny thing. It just blows people's minds. Like if you ever just talk to somebody who doesn't know anything about like financial stuff, like a couple of my buddies and everything, I'm just like, what happens if you double a penny every day? How much money are you going to have? And they just sit there and go like, they start doing like the math in their head, and they're like writing it down, and they come out with 800,000 or 80,000 or 50,000. They just throwing out all kinds of crazy numbers. And meanwhile, it's like it's millions, right? But anyways, so that continues to compound. And if you don't use it right away, that 35,000, you're gonna have that 35,000 every single year. So in 5 years, you could take a loan of 175,000. So
Every year, Ian, you're going to get more of that 50,000.
Okay.
So by year five, you have 250,000 in there.
By year five, you could take a loan on the full 250.
Yep.
Okay. All right. So the 70% just early on, and then it gets better the longer that you're in it.
It gets more and more efficient every single year.
Gotcha. Okay. And what would you say would be let's say and to be fully honest with you, I don't have 50,000 just to throw into some bucket, right?
Sure.
Like, cause I have a lot of speculative investments going on. I have
liquidity anxiety.
And guess what? I have a portfolio of cash sucking real estate, right? Like it just cash sucks everything. But let's say I have, what do you think is the lowest amount that you would recommend?
Yeah. I mean, what I see a lot of people doing is they start to put their money in here and then they start to see the power of it. And then you can buy more and more policies. Like there are people that have 5, 6, 7 policies, but I say, Ian, if you're going to do it, don't do less than 10 grand a year. I mean, it's just not worth it at that point. Like if you can't save $10,000 and put it in one of these policies, like give me a break. But I think $10,000 is a place to start. That's not going to hurt anyone. Again, guys, if the first year or the second year you say I don't have the 10 grand, you only need to put 2,500 or 3,000 or whatever, depending on your, underwriting. So it's really not that big of a commitment every year. And that's a good place to start.
So if you don't have 10 grand, what do you recommend to people?
I wouldn't do it.
What would you do with, let's say you had 5 grand, what would you do with it?
I would save up and I would go house hack.
Okay. So you'd house hack to try and turn that into your 5 grand into 10 grand. Is that what you're saying?
Yeah. I mean, here's the thing. If you don't have the discipline to save $10,000, then you won't have the discipline to save $10,000 for 20, 30, 40 years. Like you got to focus on your money habits first. This is a process. This is a process to put your money in an alternative savings vehicle. It's not like an overnight magic pill. It's not like real estate. People say, well, you can buy real estate with no money down. No, you really can't. Like you can, but not really.
You really can't. I mean, you can, but you really can't. I mean, even if you do one wrong step throughout the process, you're putting some money in, right? So
exactly. So that's the same exact thing. You want to have the right money habits first, right? And then when you have the right money habits, then you put yourself in a really good position to capitalize on this. But 10 grand, I would say anything less than 10 grand, it's not even worth it. And here's the thing. I've talked to people who wanted to set stuff up less than 10 grand. And I say, listen, you shouldn't, because if 10 grand is the only amount of money that you can save every year, you should be focusing on other things like investing in yourself so that you can produce more value, investing in sales, maybe go be a real estate agent for Deacon Hoover Real Estate. Heard they have a great agent training program. Get your sales up.
See, there's a salesperson that we talked about.
Yeah, produce value, and then then we can have a conversation about how to implement this in your life so that you're benefiting from it. But the most important investment that you're going to make is not in real estate. It's not in a stock. It's not in a little doggy coin. It's not in the S&P 500. It's not in real estate. It's in yourself. And that's the most important investment. And so unless you got yourself right, unless you can produce value, unless you have an abundant mindset, you shouldn't be doing this. You should be focusing on yourself.
I like it. Well, we have, I've wasted a lot of your time today, but a great conversation. I do want to ask you a couple quick questions before we go. What is your favorite business book?
Yeah. So I have so many that come to my mind, right? I think one of my favorite business books is called Poor Charlie's Almanac.
Poor Charlie's Almanac. I'm going to have to write that down. I've never read that one.
So basically, Poor Charlie's Almanac is a series of lectures from Warren Buffett's partner, Charlie Munger.
Okay.
And so it's a compilation of his lectures, and Charlie Munger is one of the greatest investors, most underrated investors in the modern era. I mean, Warren Buffett credits him with the majority of his success, right? He's a minority partner in Berkshire Hathaway. but he's still worth like $4 billion. Warren Buffett's worth like 100 and like something billion. Right. Exactly. Like, right.
What a
right,
worth
right.
it. I mean, if he
He's
can't
not
be
10,
on
he's
at
not
least
10,
50
He's
billion.
not 10. Right.
Jeez.
Right. So only 4. I mean, you know what I mean? And so the reason why Warren Buffett talks about Charlie Munger as his key to success is because Charlie Munger thinks about the world in a really profound way. And when I say that, I mean, he uses a series of thinking models called mental models that are interdisciplinary. So he thinks about like, if I'm going to make this investment in this insurance company, or I'm going to make this investment in Coca-Cola, or this startup. They're value investors, so don't really invest in startups, but this company, I want to think about how my understanding of biology, my understanding of physics, of history, of psychology, of influence, how they all work together to allow me to think through this problem. So he calls it a latticework of mental models. So what's a mental model? A mental model is the Lindy effect that I just talked about with you. A mental model is like when you think about a problem, when you're evaluating a problem, instead of saying like what's the best thing that can go wrong, you invert it and say, why could this specific problem hurt me? Or how could this specific problem hurt me? It's called inversion. It's one of the most powerful mental models. You turn every question to a negative and you think through of exactly how, this business venture, how could this business venture hurt me? What would be my biggest drawbacks? Instead of always focusing on what are my goals, and instead
you're talking about like when we're breaking down a property and I'm like, what happens when you're no longer getting $1,800 a month in rent and goes down to $1,000 a month in rent, right? Like
I said, dude, I've been invested for 13 months. I would know better than you.
All right.
No, you got what I'm saying.
Yeah, no, I get it. I'm definitely gonna check that one out. Do you have a favorite real estate book?
Oh man, real estate book.
Don't use the cliche. Don't use the.
No, I'm not using it.
Don't use the rich dad.
The best real estate book that I've ever read. There are a couple of them, but I've read a couple of multifamily books that were really good. The book on negotiating real estate, which is a Bigger Pockets book, it's pretty good. All the Bigger Pockets books about investing in real estate are pretty good. I actually read a book called Short-Term Rentals, Long-Term Wealth. So it's about short-term rentals, and it's by Avery Carl, which I actually had on my podcast. And her episode wasn't as good as Ian's, I will say that, but it was pretty close. And
it's tough to battle craziness, like
right. Yeah. So short-term rentals, long-term wealth, but anything by Bigger Pockets Publishing, I really like.
Okay. Well, I will tell. So I think it would help with anybody getting into any kind of business, but my favorite, it changes all the time depending on my mood, but my favorite real estate book is called The 7 Levels of Effective Communication.
I got it up there.
It's a great book. And I love, like, some books, I always say, like, like for instance, for me, the 4-Hour Work Week was a super tough read because it's just Tim Ferriss, just like, this is what I do. This is how I do it. This is what you should do. This is how you should do it. Like, just the whole time when like the 7 levels are telling a story, the market crash, my business went south. I met this lady. This is what she's doing. I can't believe this can't work. This does work. I've tried this. This works, and it just got some really cool ideas from it. It's a great book. And then my favorite, we talked about, I think on your podcast, my favorite, overall business book was the Art of the Deal, which is just a fantastic book, puts you in the mind of a billionaire. Where's the one place that you want to go on a vacation that you never gone on vacation before?
Oh, the Himalayas.
Himalayas. Okay. Why is that?
Because I'm a really outdoorsy person, and oh gosh, can't believe I just strung that sentence together. Right. You're gonna look at the background. There's gonna be like bless and peace and all that stuff too. No, I really like challenges, and I like the mountains. I mean, I am in love with Colorado. When I was in Buenos Aires in Argentina, I went to see Aconcagua, which is the largest mountain outside of the Himalayas. It's like 22,000 feet, 23,000 feet, which is absolutely enormous. It's like huge, but it's like a big bulb, right? It's like a huge pimple shape type of thing. And the Himalayas are stark and sheer, and they're just like straight up. And you're in the Himalayas, and you're at the base at like 14,000. And I've climbed a lot of 14,000, feet mountains, and it's just another level. I mean, you fly into Kathmandu in Nepal, and people get like alpine sickness or altitude sickness just like by flying into Kathmandu because it's so high. So that kind of stark. Like, I want to go hiking with my fiance in the Himalayas.
See, it's mind blowing to me that where I would say we're like-minded. Okay. We're at the very least, we're like-minded. We're both business savvy. We're both investment geeks. We both love real estate, but we're just completely opposite on that. Right. Like my dream vacation is like, let me go to Vegas and hit some blackjack tables for 5 days straight and go on a binger, right? You're like, I want to go climb a mountain. I'm just like, that sounds miserable, right? Like, that's just nothing I want to do. Like, but hey, everybody's different, right? More power to you. And one last thing, just because we ended your podcast that way, because I said I'm a little crazy and I always do the craziness stuff. Did you go down the space rabbit hole after I mentioned it?
So I was gonna open up our podcast with that. I was thinking I was gonna come here. I was gonna sit down and like look up some like space fact and like blow your mind at the end. But I was looking at that duplex. So as the real estate addict in me,
yeah,
duplex came higher up in on my value hierarchy. I'm sorry, and nothing against you, buddy, but
so you're not flying 9 years to a moon on Pluto anytime soon, is what you're saying?
Yeah, no, but that the hottest planet in our solar system is 450 degrees Celsius.
That's what, Venus, right?
That's Mercury.
Oh, Mercury. Okay. Yeah, no, I didn't know that.
Do you know that a full NASA spacesuit costs $12 million?
Wow, one spacesuit, $12 million.
Yep.
Yeah, that's crazy.
And here's the last one. 1 million Earths can fit inside of the sun.
That's pretty crazy.
What?
I didn't think the sun was that big. That's pretty crazy. Yeah, like that's just the stuff that is like, you just think about it. It's kind of unreal, right? We could all be swallowed up by a black hole tomorrow. You got to watch the movie. If you haven't seen it, you got to watch the movie on Netflix. Don't Look Up.
Oh, really? I'm thinking about watching it.
Yeah, it's like loosely based on like true events, but it's not really a true story. But it's like, it's so crazy, but it's at the same time, you could kind of see how it could be, like it could actually happen. You know what I mean? And by the way, like I had a conversation earlier today with somebody that like, I usually hate how things end. I'm not a big like ending of shows, like Sopranos.
Right.
Sopranos is horrible. Dexter, I didn't like how they ended. Like all my shows, I hate how they ended. The ending of Don't Look Up has to be one of, if not the best ending I've ever seen.
Don't tell me, dude. Don't tell me.
I'm not going to ruin it, but it's like, and just like, and I'm not talking about the there's like a little like past the ending part. You know how they do that sometimes, like they'll start with like little credits and then roll into something else. And I just was like, oh my God, like this is like hilarious. That you gotta check it out. Just whenever you have nothing going on, which isn't very often. So it might be 6 months from now. Just check it out. I really enjoyed it.
I tend to watch it like Friday night movies with my fiance. We'll do Friday night movie night, and sometimes during the week we'll watch like a TV show or something. Got to be somewhat human, right?
Yeah, you got to fit it in where you can. Ozark season 4 is on right now for me, so I've been watching a couple episodes here or there. But it just kind of randomly released right around the time I went down the rabbit hole of outer space, right? And then like I was like, oh, this is fitting, and I watched it, and it was pretty entertaining. So I recommend it.
Okay.
All right, Clay. Well, hey, thanks for hopping on and wasting. Oh man, we're almost like an hour and hour and a half here. So,
Well, wait. How do people get in touch?
oh, I'm sorry. Wow. No, how do people get in touch with you, Clay?
You can reach me out on Facebook, LinkedIn, Instagram, Clay Hepler. My podcast is Creative Capitalist. Tremendous podcast. We'll have Ian on there in a couple of weeks. Actually, have some really great guests lined up. Super excited for that. And also you can reach me on my website, creative-capitalist.com. I got a little present on the website for Ian's listeners, a little webinar that I can go through, talk a little bit more about what I'm doing. And if you have any questions about setting up one of these policies, learning more about it, getting some video modules about how to think about it, how to implement it, just reach out to me, direct message. And you could text me at 412-552-3029.
Oh man, you have way bigger balls than I do. Like putting your cell phone number out like that. I like it. I dig it. That's dedication right there. I hope that some crazy person on YouTube is going to text you now with some kind of wild, derogatory,
crazy Russian babes.
So, but a real quick story, then we'll end it. My real estate brokerage, it's an electronic phone number, right? So people can text it, and we get that. It comes to email out of nowhere. I don't know if like they saw one of our like female agents or what the deal was. Out of nowhere, this dude started sending all kinds of like naked photos like to our real estate brokerage, and it's coming to my email, and I'm just like, what is going on right now?
Right, that's super.
He's like, hey baby, I want to hook up, and he's like saying, I'm like, what is going on right now? So that was like, I literally had to like call the guy. I'm like, you are sending these naked pictures to a real estate brokerage. He's like, oh. All right, Clay. We'll talk to you later, buddy.
All right, man.